Welcome to the Investing News Network. I'm Charlotte McLeod, and you're about to watch part one of my interview with Lobo Tiggre, founder and CEO of IndependentSpeculator.com. Just a reminder before we get started that if you enjoyed this video, make sure you hit the like button and subscribe to our channel. It's always a pleasure to speak with Lobo, and part one of this conversation focuses on what's going on in the gold market, including some of his latest research. We hope you enjoy. Happy to have you here as well. And where we're going to start today is with gold. We're speaking on June 29th, and I think as we speak, it's at about 1760, at least the last time I checked. I know at least the last time I checked. So I know that your recent research shows that lately gold has been tracking the US dollar more than it's been tracking real rates. So I wondered if you could start by explaining the shift you've seen there and whether you think that's going to be a long-term trend that we continue to see.
Okay, so let me just briefly tie this to the movement of the day because we started with where we're at today. And I want to say that this is not an explanation for the day-to-day fluctuations. I mean, it is and it isn't. Some days you can look at the charts and we've talked about this before. It's like the Rorschach image, right? The ink blot, the butterfly, whatever. You look at these lines and usually it's the nominal rate as a proxy for real rates that does that mirror image with gold. And it's been doing that. It's the most explanatory variable over the last 50 years since the separation of gold and the dollar. But very recently, it's this year begun doing much more of that mirror action with the dollar as represented by the DXY dollar index, dollar on foreign exchange. But so it's doing that more than not. And today it's kind of mixed. Both the dollar and rates were up in the middle of the day, and that's when gold really fell off. You got it from both sides, right? Double whammy. And then both of them have kind of rolled over and gold has kind of come back up a little bit, not back to where it was before. But so you can't really say it's one or the other. So I'm not trying to say that this will explain everything on a day-to-day basis. The significance of this is really kind of, you could back this off and ask the question the other way, like, why doesn't gold trade inversely to the dollar more often? You'd think gold is priced in dollars. So if the dollar is up, gold should be down. That's what gold trades for, right? It's in dollars. Why isn't it? Well, I mean, there are a lot of complicating factors. As we know, interest rates is one of them. Geopolitical risk is one. There are times when that safe haven demand actually favors both gold and the dollar for longer periods. In 17 and 18, you could see both of them, not in lockstep, but both of them gaining ground for a long period of time as the sort of broad fear was driving safe haven demand in both, and both are regarded as safe havens. So it's weird. You would think that gold and dollar are competing. That one is priced in terms of the other, so they should be always opposite. But it turns out they rarely are. A big picture over the last 50 years, yes, they make an X over the last 50 years, but on a day-to-day, year-to-year, or even for multi-year periods, they can move together. What does have more explanatory power is the nominal rate as a substitute for real rates. Real rates are the most correlate inversely with gold. And so here's the punchline. So that's changing this year. That's really interesting. That's different. Why is that happening? And I think that what this really is evidence of is that the traders around the world who trade these futures contracts that we like to call the price of gold or silver, they've been using nominal rates as proxies for real rates because that's the powerful driver. But now they're kind of calling BS on that. They understand that real inflation is changing. They understand that adjusting by monthly CPI isn't good enough on a day-to-day basis if inflation is changing. And so I think that a lot of traders are starting to go directly to the dollar instead of using real rates as a proxy or as an indicator where the dollar will be. Since interest rates aren't telling an accurate picture right now, I think traders are starting to look directly at the dollar, and that's why we're seeing that happen. Now, real quick, why does this matter? It's different. It's interesting. Okay, who cares? It's all intellectual. No, the reason why I care is because I'm a dollar bear. Now, if you're a dollar bull, maybe this isn't great news. But if you, like me, are a dollar bear, this is great news because it means, if we're right about what happens to the dollar, then we have high confidence in what happens to gold and silver, by the way, which I still see very much as a monetary metal.
Right. And what I wanted to ask is, if you're saying as these traders are watching the dollar, should gold investors now be watching the dollar more closely? And you mentioned you're a dollar bear. What's your outlook for the dollar, let's say in 2021?
Right. Yes. So yes, I do think you should be watching the dollar closely. And I think that the real takeaway here is that in the near term, the dollar bear thesis might take it on the chin a bit. We've got the reopening, the great reopening in the U.S. And it's really funny because on the one hand, the great reopening, that's inflationary, right? Even the Fed says that's transitorily inflationary. And you'd think, well, inflation, that's bad for the dollar. Inflation is reducing the purchasing power of the dollar. So how can the dollar go up? Well, but by conventional economics, that inflation is because the economy is doing so great. It's because the US is doing so great. It's because business is booming. And so that creates demand for dollars. If foreigners want to participate in that booming US economy, they need dollars to do it. Or if they're worried about their economy not doing so well, then they need dollars to do it. So ironically, this it seems crazy, right? Oh, we've got higher inflation, therefore we should go into the dollar. And if I'm right about that, if that is crazy, if that is the wrong thing to do, as is it Dalio who likes to say that cash is trash, right? If he's right, if I'm right, then that is transitory. That's the transitory part, right? The US economy isn't really booming. It's rebounding from an artificial shutdown. And then how high will it be afterwards? We don't know. I think most sensible people don't expect it to be, the roaring 20s, despite the temptation for that parallel. So here's the guidance. You know me, I don't like to make big, bold predictions, gold at 2,700 by September 15th or anything like that. That's not me. But what I'm saying is that this shift to looking at gold more directly in terms of the dollar is actually very near-term bearish, because there's a lot of story right now, narrative that looks good for the dollar. And so in the near term, that's bad for gold. But I think anything other than the near term, what's being done in the US is much more harmful to the currency. I think we're going to see more currency debasement here. I think you're going to see more fiscal and monetary. And the people that think the Fed is going to raise rates, I think they need to understand the Fed would taper its asset purchases before it raises rates. So even if they begin, they're talking the dot plot, all that stuff, they're talking about thinking about beginning to tighten in 2023. But even that isn't necessarily interest rates. That could begin, or should begin most likely, with asset purchases. So I just think it's wrong for people to assume that the Fed is going to tighten interest rates anytime soon. And therefore, this headwind is temporary. Therefore, that's a buying opportunity. Now, I could be wrong, Charlotte. I don't pretend to know the future, but this is how it looks to me. I am very dollar bearish in anything other than the near term. And that makes me inclined to buy now. And I am putting my own money where my mouth is. As you and I speak, it is June 29th. I bid on 3 stocks today. And as we started this interview, the market closed. I don't know if I got filled on any of them, but I'll tell you, I'm putting my money where my mouth is. I don't know what'll happen, but I'm confident enough in my thesis that I'm willing to invest accordingly.
Okay, and as people will know if they've been following you for a while, you've been bullish on gold for some time. So I guess a question that I have is this a new way of looking at the bullish scenario, or does it change anything specifically for gold and the gold price in the future?
I mean, there's bullish and there's bullish, Charlotte. I remember, because I've been, maybe twice bitten, thrice shy on this whole thing after 2011, and after the big crash in 2008, and we were so confident that this was it. The whole system was blowing up. The global financial house of cards was coming down, and gold was going to go up to whatever. And many of us did not see how the powers that be could kick the can down the road and get the economy going again, and yet they did. Right? So that makes me very cautious about just always being yay permabull all the time. But but in late 2017, and we had that rally in gold in 2016, the market had turned late 2017. I said, you know what, I really do think the bottom is in here. That 2015, late 2015 was the bottom. This may sound like ancient history now, but I'm trying to answer the question as honestly as I can. Is yeah, I've been bruised. Yeah, I've been too optimistic before. And that actually makes me more cautious now. So it was actually in January of 2018 that I started getting more strongly bullish again. Now, I've been bullish throughout, and that's turned out well. If you think about if you were new and you listened to Lobo in early 2018, well, where's gold now compared to then? You would have done really well. You would have made a lot of money on the stocks. So I don't feel bad about having been bullish over this time, but I'm very conscious of when I was too bullish before, and I'm trying to watch out for that. So no, this switch from rates to the dollar doesn't change that. And I don't know how long it will last. When the inflation numbers start actually matching reality, when people stop saying, you know what, I don't believe these numbers, it could go back. But for now, it supports something that I had, a more fundamental view just on the monetary and fiscal policy. So it's doesn't change anything, but it gives me a way to track it better now that I feel good about. And I'll tell you, my gold bug friends out there won't like it, but if there comes a day when I'm thinking, you know what, it's done, like this thing has peaked, we're likely going to look at years of downturn here, I will say that. I will be selling, at least my stocks. I don't know if I'll ever sell any of my bullion. That's long-term savings, right? But I don't have any intention of going down with the ship. So there will be a day where you'll have me on your show, and I'll be saying, I'm selling my gold stocks. I'm not looking to buy any gold stocks right now. There's a prediction for you.
Yeah, I don't doubt it. Yeah, and that will certainly be an interesting day. I do want to ask you about the gold stocks right now. You mentioned you're buying today. I don't expect you to tell us what you've been buying, but this is an opportunity. Maybe you can talk about what types of stocks you're looking at right now, and perhaps how the gold stocks have been performing in 2021 as a whole.
Right. Well, I think you've probably had guests on, and in your audience probably heard plenty of people talking about how cheap the gold stocks are in terms of gold. I've done that chart too. And yeah, they're beat up, and I'm sure you've had plenty of guests talking about how bearish sentiment is and how people are giving up on the gold stocks. People are disgusted. And your contrarians will say, that's great. This is a perfect market. I want to buy. That gives me a chance to buy great companies cheap. And that is exactly what I'm looking to do. I've got stink bids out there, and I have a feeling I didn't get any of them filled today, but maybe I will tomorrow. We'll see. I'm perfectly happy to take this bearish sentiment and people giving up. And frankly, it's kind of sad, Charlotte, because you'll get people who will get all excited when gold's going up, right? Woohoo, $2,000 gold, we're going to be rich. Everybody piles in, and then it goes into correction mode. Oh no, these stocks are wiping out my portfolio. Gold's terrible. It's the worst thing I ever did. And then they sell, right? So they bought high and then they sold low, and then it goes up again, and they repeat the process until they just give up entirely. It's a sad thing, but it happens. I'm not answering your question about types of companies. And I don't really, I would say that the opportunities are so broad-based that I find myself uncharacteristically looking at the majors as well as the smaller companies, Charlotte. Anything that I can see as having a compelling value proposition is of interest to me. And when the stocks are so relatively undervalued compared to the commodity they produce, even the majors can be doubles, triples. Some companies I won't name, some famous companies in our space have gone up 5x during a bull market like that. So even the big ones can make a hockey stick. So I'm looking at anything that's compelling. And I'll say just one last thing on this, rather than a company type, let me give you something else that I hope is useful. A lot of my readers, at least, have been asking about, well, what if there's a market crash, right? What if the Fed makes noises about tightening and the markets all crash, and what will that do to our stocks? And should we be buying anything now? Like, we agree with you that it's an opportunity. We agree with you that gold's going to go up, but should we really be buying anything now if the market might crash? And I actually have a free article on the free side of the website called The Crash of 2021, if anybody wants to see more details on this. But the quick answer is yes and no. The yes is we don't know that the market's going to crash. They're printing so much money. I mean, who knows how many more trillions Biden and the blue wave will get out of Washington. There might not be a crash. There could be so much easy money, and the Fed could be just sort of, jawboning, but not really going to do anything still for years. I mean, this big scare with the dot plot isn't for 2 years, Charlotte. It's 2023, and then some one lone Fed guy says, well, maybe 2022, and the market all panics, and another guy says, no, we don't mean that at all. So I just think it would be a mistake to say, no, there's gonna be a market crash this year. They could put that off. But if there is, I sure want to have cash available for that. So that's the no part. So all I'm saying is don't go all in now. I see great opportunities now. I see undervalued, compelling value propositions on the market today, and I'm willing to buy. But I'm not going all in. I'm buying, the first stake in what I think would be an ideal position. And then I'm holding some cash back. And if we get that market meltdown, I would love to have the chance to average down substantially, lower my cost basis. Just like you could have done in March of 2020, if you had the guts to do that. What a buying opportunity that was. I'd love to have that chance again.
Right. And I'm not sure if we should even try to talk about that potential for a market crash, but it's certainly something that we do keep hearing about, and especially with the continued printing of money in the US and globally, what do you make of that? I know you don't like to make predictions, but how are you feeling? Are you feeling one way or another? Is this something we should be thinking about or more put out of our minds? How do you deal with that, looming possibility, but also it definitely might not happen?
Well, I've told you what I am doing. I'm buying. I have 3 stocks today, as you and I speak, that I tried to buy, and I don't know yet whether I got filled on any of them. So I'm not sitting on my hands and saying, oh, the market might crash. I am sitting on a lot more cash than I normally would because the market might crash. So that's my answer is I don't know. And rather than try to bet, all one way or the other, I'm playing it both ways. I don't have to know. If there is a crash, everything I'm buying today, I would be happy to buy more of at a lower price, right? And if there isn't a crash, I'm sure glad I didn't wait for it, right? I got in at prices that I liked. I place low bids, stink bids, and if I get filled and it goes on up from here, I'll do fine from there. So that's my own way. Is don't worry about trying to figure it all out and to know the future. Nobody knows these things, right? We all, the most erudite guest you have with the most complex theories, the most intellectual arguments, and the greatest amount of data and number, they don't know. It's still a guess. It's a guess dressed up in lots of math and fancy verbiage, but it's still a guess. So, hedge your bets.
Thanks for watching part 1 of my interview with Lobo Tiggre of IndependentSpeculator.com. If you'd like to see part 2, which focuses on the uranium market, you can find the link below.